Interest rates play a crucial role in the economy, influencing everything from borrowing costs to investment returns. But how do interest rate hikes impact your investment portfolio? In today's video, we'll break down the effects of rising interest rates on different asset classes and what you can do to protect and optimize your investments. First, let's quickly understand what an interest rate hike is. Central banks, like the Federal Reserve and the US RBI in India, raise interest rates to control inflation and stabilize the economy. When rates go up, borrowing becomes more expensive, which can slow down economic growth. Bonds are one of the most directly affected asset classes by interest rate hikes. When rates rise, bond prices typically fall. This happens because new bonds issued at higher rates become more attractive, making existing bonds with lower rates less valuable. If your portfolio includes a significant amount of bonds, you might see a decrease in their value during a period of rising interest rates. Rising interest rates can also affect the stock market, but the impact varies depending on the sector. Higher rates increase borrowing costs for companies, which can squeeze profit margins and lead to lower stock prices, especially in sectors like real estate and utilities that rely heavily on debt. However, financial stocks, like banks, often benefit from higher rates as they can charge more for loans. Real estate investments are particularly sensitive to interest rate changes. Higher rates mean more expensive mortgages, which can reduce demand for property and slow down price growth. This can affect both direct real estate investments and real estate investment trusts, REITs, in your portfolio. Commodities like gold and oil often react differently to interest rate hikes. While rising rates can strengthen the currency, making commodities priced in that currency more expensive, it can also lead to lower demand and price drops. However, gold is sometimes seen as a hedge against inflation, which can lead to mixed reactions in its price during rate hikes. So, how can you protect your portfolio from the effects of interest rate hikes? Diversification. One of the best strategies is diversification. By spreading your investments across different asset classes, you can reduce the impact of any single rate hike. Focus on quality stocks. Look for companies with strong balance sheets and low debt, as they are less affected by rising borrowing costs. Consider short-term bonds. Short-term bonds are less sensitive to interest rate changes, so they can offer some stability in a rising rate environment. Reassess real estate exposure. If you're heavily invested in real estate, consider the potential impacts of rising mortgage rates and adjust your exposure accordingly. Interest rate hikes are a natural part of the economic cycle, but they can have significant effects on your investment portfolio. By understanding these impacts and implementing smart strategies, you can navigate rising rates with confidence and keep your financial goals on track. If you found this video helpful, be sure to like, share, and subscribe to Money Secrets for more insights on managing your investments and growing your wealth. Have any questions or topics you'd like us to cover? Let us know in the comments below.